Question 1. Comparative studies suggest that the application of RMD rules for qualified annuities can be a point of confusion for financial professionals. A CAS is advising a 72-year-old client who has a qualified annuity and whose spouse, who is 58 years old, is the sole designated beneficiary. The CAS needs to determine the correct method for calculating the client's RMD for the upcoming year. Option A. Calculate the RMD using the joint life and last survivor expectancy table, considering the client's age and the spouse's age, and the account balance as of December 31st of the previous year. Option B. Calculate the RMD using the uniform lifetime table and the account balance as of December 31st of the previous year. Option C. Calculate the RMD using the uniform lifetime table and the account balance as of January 1st of the current year. Option D. Calculate the RMD using the client's life expectancy based on their age alone, without considering the spouse's age, and the account balance as of December 31st of the previous year. The correct answer is B. Calculate the RMD using the uniform lifetime table and the account balance as of December 31st of the previous year. Explanation. This scenario is professionally challenging because it requires the certified annuity specialist CAS to navigate the complex and often misunderstood rules surrounding required minimum distributions (RMD) for qualified annuities, specifically concerning the uniform lifetime table and the joint life and last survivor expectancy table. The CAS must not only understand these tables, but also apply them correctly based on the annuitant's circumstances and the specific type of qualified annuity. Misapplication can lead to significant tax penalties for the client and potential professional repercussions for the CAS. The correct approach involves accurately determining the annuitant's age and, if applicable, the age of a spouse or designated beneficiary who is more than 10 years younger, to select the appropriate life expectancy table for calculating the RMD. The CAS must then apply the distribution period from the chosen table to the account balance as of December 31st of the preceding year. This meticulous adherence to IRS regulations, particularly those outlined in IRS Publication 590B, ensures compliance and avoids the 50% IRS penalty on the amount that should have been distributed. An incorrect approach would be to assume the uniform lifetime table is always applicable, even when a significantly younger spouse is the sole beneficiary. Failure to consider the specific beneficiary designation and age difference violates the spirit and letter of the law, which provides a more favorable calculation method in such cases. Another incorrect approach would be to use the account balance from the current year instead of the preceding year-end balance, which is a direct contravention of the RMD calculation methodology. Furthermore, relying on outdated or generalized information without consulting the most current IRS publications or seeking professional guidance would also constitute a significant ethical and regulatory failure. Professionals should approach RMD calculations by first identifying the type of qualified plan and annuity. They must then ascertain the annuitant's age and the age of any designated beneficiary, paying close attention to the age difference if a spouse is the beneficiary. Consulting the most current IRS publications, e.g., Publication 590B, for the applicable tables and rules is paramount. If there is any ambiguity or complexity, seeking clarification from tax professionals or the IRS itself is a prudent step. This systematic process ensures accuracy, compliance, and client protection. Question 2. System analysis indicates that when discussing annuity products with potential clients, the financial professional must effectively communicate the underlying pricing structure. Considering the certified annuity specialist, CAS, exams focus on regulatory compliance and ethical conduct within the U.S. regulatory framework, which approach best reflects the professional's obligation regarding the spreads or margins embedded in annuity premiums. Option A. Highlight the competitive nature of the annuity market and suggest that the spreads are simply a reflection of the insurer's profit margin, implying that lower spreads are always indicative of a better product for the consumer. Option B. Focus on the projected growth rates of the annuity without detailing how these projections are influenced by the embedded spreads, as detailed cost breakdowns can be overly complex and may deter potential clients. Option C. Provide a clear and understandable explanation of how the premium is allocated, including the role of explicit and implicit spreads in covering operational costs, mortality risk, investment management, and contributing to the insurer's profitability, thereby enabling the client to understand the product's overall economic structure. Option D. Emphasize that the guaranteed benefits are the primary focus for the client, and the internal cost structure, including spreads, is a matter for the insurer's internal management and not typically disclosed in detail to the client. The correct answer is D. Emphasize that the guaranteed benefits are the primary focus for the client, and the internal cost structure, including spreads, is a matter for the insurer's internal management and not typically disclosed in detail to the client. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of how annuity product pricing, specifically the embedded spreads or margins, impacts both the insurer's profitability and the consumer's value proposition. The challenge lies in balancing the need for the insurer to remain solvent and profitable with the ethical obligation to provide fair value to the annuitant. Misinterpreting or misrepresenting these spreads can lead to regulatory scrutiny, consumer dissatisfaction, and reputational damage. Careful judgment is required to ensure transparency and fairness in the product offering. The correct approach involves clearly articulating the components of the annuity's cost structure, including the explicit and implicit spreads, and how these contribute to the overall premium. This approach aligns with regulatory principles of disclosure and fair treatment of consumers. By providing a transparent breakdown, the financial professional demonstrates a commitment to educating the client about the product's economics, enabling informed decision-making. This is ethically sound as it fosters trust and avoids potential misinterpretations about the value received for the premium paid. Regulatory frameworks often emphasize the importance of clear and understandable disclosures regarding product costs and fees. An incorrect approach would be to focus solely on the guaranteed benefits without acknowledging the underlying cost structure and the spreads embedded within the premium. This failure to disclose the cost components can be seen as misleading, as it may lead the client to believe they are receiving a higher return or more value than is actually the case after accounting for the insurer's operational costs and profit margins. This lack of transparency can violate regulations requiring full and fair disclosure. Another incorrect approach would be to present the spreads as solely a reflection of the insurer's profit margin, without explaining their role in covering operational expenses, mortality risk, and investment management. This incomplete explanation can create a negative perception of the insurer and potentially lead to client objections based on a misunderstanding of the product's pricing. Ethically, it is important to provide a balanced view of the cost structure, not just the profit component. The professional decision-making process for similar situations should involve a thorough understanding of the annuity product's pricing mechanics, including all embedded costs and margins. Financial professionals must prioritize clear, accurate, and comprehensive communication with clients. This includes explaining how premiums are allocated, the role of spreads in covering insurer expenses and risk, and how these factors ultimately influence the benefits provided. The focus should always be on empowering the client with sufficient information to make an informed decision that aligns with their financial goals and risk tolerance, adhering strictly to all applicable regulatory disclosure requirements. Question 3. Investigation of an annuity specialist's interaction with a prospective client reveals that the client, a 75-year-old retiree with limited investment experience, expressed a strong desire to purchase a specific fixed annuity product that was heavily marketed for its guaranteed income stream. The specialist, eager to close the sale, focused primarily on explaining the income benefits and did not thoroughly explore the client's liquidity needs, understanding of surrender charges, or overall financial capacity to absorb potential long-term illiquidity. The specialist also provided a brochure that highlighted the guaranteed income, but did not prominently feature the surrender charge schedule or the potential impact of inflation on the fixed income payments. Which of the following approaches best demonstrates compliance with regulatory guidelines for annuity sales? Option A. Conduct a detailed suitability assessment, documenting the client's financial situation, objectives, risk tolerance, and liquidity needs, and then provide a comprehensive disclosure of all annuity features, benefits, and risks, including surrender charges and inflation impact, before proceeding. Option B. Provide the client with a summary of the annuity's guaranteed income benefits and a brief mention of surrender charges, assuming the client will ask for more details if needed. Option C. Recommend a different, simpler investment product that the specialist believes is more suitable, without fully explaining why the requested annuity might not be appropriate. Option D. Proceed with the sale, as the client explicitly requested the product and the specialist provided marketing materials highlighting its key benefit. Correct answer is D. Proceed with the sale, as the client explicitly requested the product and the specialist provided marketing materials highlighting its key benefit. Explanation. This scenario presents a professional challenge because it requires an annuity specialist to navigate potential conflicts between client needs and regulatory requirements, specifically concerning suitability and disclosure. The specialist must exercise careful judgment to ensure that recommendations are not only financially beneficial to the client, but also fully compliant with the regulatory framework governing annuity sales. The core of the challenge lies in balancing the desire to offer a product that meets the client's stated objectives with the obligation to provide complete and accurate information about all associated risks and benefits, as mandated by regulations. The correct approach involves a thorough, documented assessment of the client's financial situation, investment objectives, risk tolerance, and liquidity needs, followed by a recommendation that demonstrably aligns with these factors. This approach is correct because it directly addresses the regulatory requirement for suitability. By meticulously documenting the client's profile and the rationale for the annuity recommendation, the specialist creates a clear audit trail demonstrating compliance with the principle that all recommendations must be suitable for the specific client. Furthermore, providing comprehensive disclosure about the annuity's features, fees, surrender charges, and potential tax implications ensures transparency and upholds the ethical obligation to act in the client's best interest. An incorrect approach would be to proceed with the sale based solely on the client's expressed interest in a particular annuity product without conducting a comprehensive suitability assessment. This is a regulatory failure because it bypasses the fundamental requirement to verify that the product is appropriate for the client's individual circumstances. Ethically, it risks misrepresenting the product's suitability and potentially exposing the client to undue risk or financial detriment. Another incorrect approach would be to provide a superficial suitability assessment that does not adequately probe the client's financial sophistication or liquidity needs, especially if the client is elderly or has complex financial situations. This is a regulatory failure, as it falls short of the due diligence required to establish suitability. Ethically, it demonstrates a lack of commitment to understanding and serving the client's best interests, potentially leading to a recommendation that is not truly appropriate. A third incorrect approach would be to highlight only the positive features of the annuity while downplaying or omitting information about its drawbacks, such as surrender charges or limited liquidity. This constitutes a regulatory failure by failing to provide full and fair disclosure. Ethically, it is deceptive and undermines the client's ability to make an informed decision, violating the principle of transparency. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client. Conduct a detailed fact-finding process to gather comprehensive information about the client's financial situation, objectives, risk tolerance, time horizon, and liquidity needs. 2. Assess suitability. Objectively evaluate whether the proposed annuity product aligns with the client's profile, considering all its features, benefits, and drawbacks. 3. Provide full disclosure. Present all material information about the annuity, including fees, charges, surrender provisions, tax implications, and any potential risks, in a clear and understandable manner. 4. Document everything. Maintain thorough records of all client interactions, suitability assessments, disclosures made, and the rationale for the recommendation. 5. Seek clarification. If there is any ambiguity or uncertainty regarding the client's needs or the product's suitability, seek further clarification from the client, or consult with compliance or legal departments. Question 4. The performance metrics show a period of market volatility, and a client, who is nearing retirement, has expressed a strong desire for guaranteed lifetime income, but also wants the potential for their annuities account value to grow and retain some flexibility in accessing funds before annuitization. Considering these objectives, which of the following rider approaches would best align with the client's stated needs and regulatory suitability requirements? Option A. A rider that provides enhanced death benefits without any guarantees related to income or accumulation. Option B. A rider that guarantees a minimum income stream for life, with the income amount determined at the time of annuitization or a future point, and allows for potential growth of the underlying account value. Option C. A rider that guarantees a minimum income stream for life, with the income amount fixed at the time of rider purchase or a specific future date, and limits future growth potential. Option D. A rider that guarantees the account value will grow to a specified minimum amount by a future date, irrespective of market performance. The correct answer is B. A rider that guarantees a minimum income stream for life, with the income amount determined at the time of annuitization or a future point, and allows for potential growth of the underlying account value. Explanation: this scenario is professionally challenging because it requires the CAS professional to navigate the nuances of different guaranteed benefits within annuity contracts, specifically focusing on the client's stated goals versus the product's inherent design. The client's desire for flexibility and potential for growth, coupled with a need for income security, creates a complex decision point. The CAS professional must accurately assess which rider best aligns with these competing objectives while adhering to regulatory disclosure and suitability standards. The correct approach involves recommending the Guaranteed Lifetime Withdrawal Benefit, GLWB, rider. This approach is right because a GLWB is specifically designed to provide a guaranteed income stream for life, regardless of market performance, while still allowing for potential account value growth. This directly addresses the client's stated need for income security and their desire for some flexibility and growth potential. Regulatory and ethical justification stems from the principle of suitability. The CAS professional has a duty to recommend products and features that are appropriate for the client's individual circumstances, objectives, and risk tolerance. The GLWB aligns with the client's expressed goals of guaranteed income and some growth, making it the most suitable option. Recommending the Guaranteed Minimum Income Benefit, GMIB, rider is an incorrect approach because while it guarantees a minimum income, it often locks in the income benefit at the time of purchase or a specific point, potentially limiting future growth and flexibility. This may not fully align with the client's desire for potential growth and flexibility. The regulatory failure lies in potentially recommending a product feature that is less aligned with the client's stated objectives, thus failing the suitability standard. Suggesting the Guaranteed Minimum Accumulation Benefit, GMAB, rider is also an incorrect approach. A GMAB guarantees that the account value will grow to a certain minimum amount by a specified date, regardless of market performance. While it offers accumulation protection, it does not directly guarantee lifetime income. This fails to address the client's primary concern of guaranteed lifetime income, making it unsuitable. The ethical failure is in prioritizing a feature that doesn't meet the client's core need for income security. Recommending a rider that offers only accumulation protection without any income guarantee, or suggesting a product without any riders, would be incorrect because it completely ignores the client's explicit need for guaranteed lifetime income. This would be a significant breach of the suitability standard and a failure to act in the client's best interest. The professional decision-making process for similar situations should involve a thorough discovery of the client's financial goals, risk tolerance, and time horizon. This should be followed by an objective evaluation of available annuity products and their associated riders, comparing how each feature addresses the client's specific needs. The CAS professional must then clearly explain the benefits and limitations of each suitable option, ensuring the client understands how each choice aligns with or deviates from their objectives, and ultimately recommending the option that best meets the client's stated needs and regulatory requirements. Question 5. The performance metrics show a consistent historical yield for a money market subaccount within an annuity contract. Which of the following approaches best aligns with regulatory requirements for communicating this information to a client? Option A. Present the historical yield and explain that money market subaccounts are designed for capital preservation and liquidity, while also discussing the associated risks such as interest rate and credit risk, and ensuring the client has reviewed the prospectus. Option B. Provide a general overview of how money market funds typically perform, without referencing the specific subaccount's prospectus or the client's annuity contract details. Option C. Highlight the subaccount's low volatility compared to other subaccount options as the primary benefit, without dwelling on the possibility of principal loss. Option D. Focus solely on the attractive historical yield, suggesting it represents a stable and predictable return for the client's investment. The correct answer is A. Present the historical yield and explain that money market subaccounts are designed for capital preservation and liquidity, while also discussing the associated risks such as interest rate and credit risk, and ensuring the client has reviewed the prospectus. Explanation: this scenario is professionally challenging because it requires the certified annuity specialist, CAS, to interpret and communicate complex subaccount performance data to a client in a way that is both understandable and compliant with regulatory requirements. The CAS must balance the client's desire for clear performance indicators with the need to avoid misrepresentation or oversimplification, particularly concerning the inherent risks and volatility of money market subaccounts. Careful judgment is required to ensure the client's understanding aligns with the actual investment characteristics and regulatory disclosures. The correct approach involves presenting the performance metrics of the money market subaccount in the context of its stated investment objectives and risk profile, as outlined in the prospectus. This includes highlighting that money market funds are designed for capital preservation and liquidity, and while they aim to maintain a stable net asset value (NAV) of $1.00 per share, they are not risk-free. The CAS must also ensure that any discussion of performance is accompanied by a clear explanation of the associated risks, such as interest rate risk and credit risk, and that the client has received and understood the relevant disclosure documents. This aligns with regulatory requirements that mandate fair and balanced communication, preventing misleading statements about investment performance and ensuring clients are fully informed about the nature of their investments. An incorrect approach would be to solely focus on the historical yield of the money market subaccount, without mentioning its primary objective of stability or the potential for losses, even if infrequent. This misrepresents the investment's risk profile and could lead the client to believe it is a guaranteed return or a risk-free asset, violating regulations against misleading advertising and misrepresentation of investment products. Another incorrect approach would be to emphasize the subaccount's low volatility in comparison to equity subaccounts as the sole selling point, without adequately explaining that low volatility does not equate to no risk, and that principal loss is still a possibility, however remote. This selective presentation of information can create an inaccurate perception of safety and could be construed as a failure to provide a complete and balanced picture of the investment, which is a regulatory concern. Finally, an incorrect approach would be to provide a simplified, generalized statement about money market subaccounts performance without referencing the specific subaccount's prospectus or the client's individual annuity contract. This lack of specificity and reliance on generic information fails to meet the regulatory obligation to provide accurate and relevant information pertaining to the client's actual investment choices and the terms of their contract. Professionals should adopt a decision-making framework that prioritizes client understanding and regulatory compliance. This involves 1. Thoroughly understanding the specific money market subaccount's investment objectives, risks, and historical performance as detailed in its prospectus. 2. Assessing the client's financial situation, risk tolerance, and investment goals. 3. Communicating performance data in a balanced manner, always contextualizing it with the subaccount's risk profile and stated objectives. 4. Ensuring all discussions are supported by and consistent with the official disclosure documents. And 5. Verifying client comprehension of both the potential benefits and risks. Question 6. The review process indicates that a client has contributed after-tax funds to a non-qualified annuity and is inquiring about the tax treatment of potential future withdrawals. Which of the following represents the most appropriate professional response for a certified annuity specialist? Option A. Advise the client that their after-tax contributions will never be taxed upon withdrawal. Option B. Inform the client that all distributions from their non-qualified annuity are tax-deferred until retirement. Option C. Explain that withdrawals from non-qualified annuities are taxed on an earnings-first basis, meaning earnings are taxable and the return of after-tax contributions is not, and strongly recommend consulting a qualified tax advisor for personalized advice. Option D. Calculate the estimated taxable and non-taxable portions of all potential future withdrawals based on the client's current contribution history. The correct answer is C. Explain that withdrawals from non-qualified annuities are taxed on an earnings-first basis, meaning earnings are taxable and the return of after-tax contributions is not, and strongly recommend consulting a qualified tax advisor for personalized advice. Explanation. This scenario is professionally challenging because it requires the CAS professional to navigate the nuances of non-qualified annuity taxation and disclosure requirements, specifically concerning after-tax contributions, without overstepping into providing tax advice. The CAS professional must ensure the client fully understands the tax implications of their non-qualified annuity, particularly how after-tax contributions affect the taxable portion of distributions, while strictly adhering to the prohibition against providing tax advice. The challenge lies in educating the client about the mechanics of non-qualified annuities and their tax treatment without crossing the line into recommending specific tax strategies or interpreting tax laws for the client. The correct approach involves clearly explaining to the client that distributions from a non-qualified annuity are taxed on an earnings-first basis, meaning that any portion of a withdrawal representing earnings is taxable income, while the portion representing the return of after-tax contributions is not. This explanation should be accompanied by a strong recommendation that the client consult with a qualified tax advisor, or CPA, to understand the specific tax consequences of their individual situation and to receive personalized tax advice. This approach is correct because it educates the client on the general principles of non-qualified annuity taxation as it relates to their product choice, fulfilling the CAS professional's duty to inform, while simultaneously directing them to the appropriate professional for specific tax guidance, thereby respecting regulatory boundaries and ethical obligations. An incorrect approach would be to attempt to calculate the exact taxable and non-taxable portions of potential future distributions for the client. This is a regulatory and ethical failure because it constitutes providing tax advice, which is outside the scope of a CAS professional's license and expertise. CAS professionals are not licensed tax advisors, and providing such calculations could lead to errors, misinterpretations, and potential liability for both the client and the CAS professional. Another incorrect approach would be to simply state that after-tax contributions are not taxed upon withdrawal without further explanation or recommendation to consult a tax professional. This is a failure because it is an incomplete and potentially misleading statement. While the return of principal is not taxed, the earnings are, and failing to explain this distinction or guide the client to professional advice leaves them with an incomplete understanding and potential for future tax surprises. A third incorrect approach would be to advise the client that all distributions from a non-qualified annuity are tax deferred. While tax deferral is a feature of annuities, this statement is inaccurate in the context of after-tax contributions and earnings. It fails to acknowledge the taxable nature of earnings upon withdrawal and the non-taxable nature of the return of principal, thus misinforming the client and failing to guide them toward appropriate tax advice. The professional decision-making process for similar situations should involve a clear understanding of the CAS professional's role as an educator and facilitator, not a tax advisor. When discussing non-qualified annuities with after-tax contribution, the professional should focus on explaining the general tax principles, e.g., earnings-first taxation, tax deferral of earnings, and then unequivocally direct the client to consult with a qualified tax professional for personalized advice regarding their specific tax situation and the tax implications of their annuity. This ensures compliance with regulations, upholds ethical standards, and protects both the client and the professional. Question 7. The performance metrics show a significant increase in annuity death benefit payouts to beneficiaries over the past year. A beneficiary has inherited a non-qualified annuity contract from their parent and is seeking guidance on the tax implications of the death benefit. The beneficiary is considering several options: receiving the entire contract value as a lump sum, electing to receive payments over their lifetime, or rolling the inherited annuity into their own IRA. Which of these options, if any, represents the most tax-efficient approach for the beneficiary, considering the general tax treatment of inherited annuity death benefits under U.S. federal tax law? Option A. Rolling the inherited annuity into their own IRA, as this allows for continued tax deferral and the ability to manage the funds within a retirement account. Option B. Receiving the entire contract value as a lump sum, as this allows for immediate access to funds and a clear tax calculation based on the deceased's basis. Option C. The tax treatment depends on whether the annuity is qualified or non-qualified and the beneficiary's relationship to the deceased, requiring a detailed analysis of the earnings portion of the death benefit. Option D. Electing to receive payments over the beneficiary's lifetime, as this can spread the taxable income over many years, potentially at lower tax rates. The correct answer is B. receiving the entire contract value as a lump sum, as this allows for immediate access to funds and a clear tax calculation based on the deceased's basis. Explanation: this scenario presents a professional challenge because the certified annuity specialist, CAS, must navigate the complex and often nuanced tax implications of annuity death benefits for beneficiaries, ensuring compliance with U.S. federal tax law and relevant state regulations. The CAS's role extends beyond product knowledge to understanding the financial and tax consequences for clients and their heirs, requiring a high degree of accuracy and ethical diligence. Misinterpreting or misapplying tax rules can lead to significant financial hardship for beneficiaries and potential liability for the CAS. The correct approach involves accurately identifying the taxable portion of the death benefit based on the deceased annuitant's tax basis in the contract and the nature of the distribution. Lump sum vs. installment payments. For non-qualified annuities, the income in respect of a decedent, rules under the Internal Revenue Code, IRC, are paramount. The portion of the death benefit representing the deceased annuitant's pre-death earnings or gains is generally taxable as ordinary income to the beneficiary. If the beneficiary receives the annuity contract outright, the tax basis is stepped up to the fair market value at the date of death, but any appreciation above that stepped-up basis remains taxable. If the beneficiary chooses to annuitize the contract, the payments will be taxed based on the exclusion ratio, with the portion attributable to the deceased annuitant's earnings being taxed as ordinary income. This approach ensures compliance with IRC sections 691 and 72 and related Treasury regulations by correctly distinguishing between the return of principal non-taxable and the earnings taxable. An incorrect approach would be to assume the entire death benefit is tax-free simply because it is a death benefit. This fails to recognize that the tax treatment of annuity death benefits is not analogous to life insurance death benefits, which are generally tax-free under IRC Section 101A. This oversight violates the fundamental tax principles governing annuities and can lead to significant underpayment of taxes by the beneficiary. Another incorrect approach would be to advise the beneficiary that the entire death benefit is subject to capital gains tax. While some portion of the gain might be treated as capital gain if the annuity was held in a manner that would generate capital gains, which is rare for standard annuities, the primary tax treatment for earnings within an annuity contract is ordinary income. Mischaracterizing the income type can lead to incorrect tax filings and potential penalties for the beneficiary. A third incorrect approach would be to advise the beneficiary that they can defer all taxation indefinitely by simply holding the inherited annuity without taking any distributions. While some deferral is inherent in the annuity structure, the IRD rules generally require taxation of earnings as they are distributed. Furthermore, the Secure Act introduced the 10-year payout rule for many beneficiaries inheriting IRAs and qualified annuities, meaning that while distributions can be spread over 10 years, the account must be fully depleted by the end of the 10th year, and distributions within those years are generally taxable. Failing to account for these distribution requirements and the eventual taxation of earnings is a significant error. Professionals should employ a decision-making framework that prioritizes understanding the specific type of annuity, qualified vs. non-qualified, the beneficiary's relationship to the deceased annuitant, spouse vs. non-spouse, and the distribution options available. This involves consulting relevant sections of the IRC, Treasury regulations, and IRS publications, and potentially seeking advice from tax professionals specializing in estate and trust taxation when complex situations arise. Ethical practice demands transparency with the client about the tax implications and ensuring that advice aligns with current tax law. Question 8. Assessment of how an annuity specialist should present various annuitization options to a client who has expressed a primary need for immediate, reliable income and a secondary desire to leave a legacy for beneficiaries, considering the regulatory requirement for full and fair disclosure. Option A. Emphasize the option that provides the highest guaranteed lifetime income, explaining that this maximizes the immediate benefit and that any remaining principal is forfeited upon death, which is a standard feature of lifetime income. Option B. Focus on the option that offers the greatest potential for investment growth, explaining that this could lead to a larger legacy, while downplaying the immediate income aspect as it may be lower than other options. Option C. Present all available annuitization options, clearly detailing the income stream characteristics, e.g., fixed vs. variable duration. the implications for principal access, and the impact on any death benefit, ensuring the client understands the trade-offs between immediate income, potential growth, and legacy preservation. Option D. Recommend the option that allows for the largest lump sum withdrawal of principal at the time of annuitization, as this provides maximum flexibility, even if it results in a lower lifetime income stream. The correct answer is A. Emphasize the option that provides the highest guaranteed lifetime income, explaining that this maximizes the immediate benefit and that any remaining principal is forfeited upon death, which is a standard feature of lifetime income. Explanation. This scenario is professionally challenging because it requires the annuity specialist to balance the client's stated immediate desire for income with the potential long-term implications of different annuitization options, all while adhering to regulatory disclosure requirements and ethical obligation to act in the client's best interest. The specialist must ensure the client fully understands the trade-offs inherent in each option, particularly regarding flexibility, potential for growth, and the impact on beneficiaries. The correct approach involves thoroughly explaining the features and limitations of each available annuitization option, focusing on how each aligns with the client's stated goals of immediate income and potential legacy. This includes detailing the trade-offs between guaranteed income for life versus options that might offer a lump sum payout or a death benefit. The regulatory framework for annuity sales, particularly under U.S. state insurance laws and federal regulations like those overseen by FINRA for variable annuities, mandates that clients receive clear, accurate, and understandable information about product features, benefits, and risks. Ethically, the specialist has a fiduciary or suitability obligation to ensure the chosen option is appropriate for the client's circumstances, risk tolerance, and financial objectives. This means not pushing a specific product or option, but facilitating an informed decision. An incorrect approach would be to present only the option that provides the highest immediate payout without adequately explaining the loss of principal access or the absence of a death benefit, thereby failing to meet the client's potential secondary goal of leaving a legacy. This violates the duty of full disclosure and could be construed as misrepresentation or omission of material facts, leading to regulatory sanctions and potential legal liability. Another incorrect approach would be to focus solely on the potential for investment growth in a deferred annuity option, without clearly articulating the delayed income stream and the risks associated with market fluctuations, which would not address the client's primary need for immediate income. This misrepresents the product's suitability for the client's stated immediate needs. Finally, recommending an option that locks in a lower income stream than currently available without a clear justification based on the client's long-term objectives or risk tolerance would also be an ethical and regulatory failure, as it does not prioritize the client's best interests. A professional decision-making process should involve a structured conversation with the client, starting with a deep dive into their financial situation, income needs, risk tolerance, and legacy objectives. The specialist should then present all suitable annuitization options, clearly outlining the pros and cons of each in relation to the client's stated goals. This includes explaining the nature of the income stream, fixed, variable, the duration of payments, life, period certain, and any death benefit provisions. The specialist must document this discussion and the client's understanding and decision. Question 9. Upon reviewing the documentation for a newly issued fixed annuity, a certified annuity specialist, CAS, notices that the contract specifies a guaranteed minimum interest rate, GMIR, of 2% for the life of the contract. However, current market interest rates are significantly higher, around 4%. The CAS is considering how to best manage this situation to ensure compliance and client satisfaction. Which of the following represents the most appropriate course of action regarding the GMIR? Option A. Assume the client understands the implications of the GMIR as it is stated in the contract and proceed with administering the annuity without further client discussion on this specific rate. Option B. Ensure the annuity contract clearly states the 2% GMIR and that this rate will be applied consistently throughout the contract's term, regardless of market performance, and confirm client understanding of this guarantee. Option C. Interpret the GMIR as a baseline that can be modified if market interest rates rise above it, allowing for potential adjustments to the applied rate to capture higher market returns. Option D. Adjust the applied interest rate to reflect the current market rate of 4%, as this would provide a better return for the client and is a common practice when market rates are favorable. The correct answer is B. Ensure the annuity contract clearly states the 2% GMR and that this rate will be applied consistently throughout the contract's term, regardless of market performance, and confirm client understanding of this guarantee. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of how guaranteed minimum interest rates, GMR, function within the regulatory framework governing annuities, specifically concerning the disclosure and implementation of these guarantees. The challenge lies in ensuring that the annuity contract accurately reflects the GMR and that the client fully comprehends its implications, especially when market conditions might suggest a higher potential return. The Certified Annuity Specialist, CAS, designation implies a commitment to upholding regulatory standards and ethical client service, necessitating a careful approach to contract administration and client communication. The correct approach involves proactively ensuring the annuity contract explicitly states the GMR and that this rate is applied consistently throughout the contract's duration, as per the terms agreed upon. This aligns with regulatory requirements for clear and accurate contract disclosures, preventing misrepresentation and ensuring the client receives the benefit of the guaranteed rate. Ethically, this demonstrates a commitment to fulfilling contractual obligations and acting in the client's best interest by providing the security of the guaranteed rate, regardless of market performance. An incorrect approach would be to interpret the GMR as a target rate that can be adjusted based on prevailing market interest rates. This fails to uphold the fundamental nature of a guarantee, which is to provide a minimum floor of return irrespective of external market fluctuations. Such an interpretation would violate regulatory mandates for contract certainty and could lead to allegations of misrepresentation or breach of contract, as the client would not be receiving the promised minimum benefit. Another incorrect approach would be to assume the client understands the GMR without explicit confirmation or detailed explanation. The contract may contain the GMR. A professional obligation exists to ensure client comprehension, particularly for complex financial products. Failing to adequately explain the GMR and its implications could lead to client dissatisfaction and potential regulatory scrutiny for inadequate disclosure and client education. A further incorrect approach would be to prioritize potential higher market returns over the contractual GMR, thereby delaying or failing to apply the guaranteed rate when market rates are lower. This undermines the purpose of the GMR, which is to provide stability and protection against adverse market movements. It also constitutes a failure to adhere to the terms of the annuity contract and a breach of fiduciary duty to the client, who purchased the annuity for the security of the guaranteed rate. Professionals should approach situations involving GMR by first thoroughly reviewing the annuity contract to understand the specific terms and conditions of the guarantee. They must then ensure that the contract language is clear and unambiguous regarding the GMR. Subsequently, they should engage in transparent and comprehensive communication with the client, explaining the GMR, its implications, and how it operates in various market scenarios. This proactive and client-centric approach ensures compliance with regulations and upholds ethical standards. Question 10. The evaluation methodology shows that when assessing the suitability of a variable annuity for a client seeking long-term growth with guaranteed death benefits, a certified annuity specialist must consider the impact of various fees. Which of the following best reflects the appropriate professional judgment regarding mortality and expense (M&E) fees in this context? Option A. M&E fees are a standard component of variable annuities and are generally accepted as reasonable if disclosed, requiring no further in-depth justification beyond their presence in the contract. Option B. M&E fees should be minimized or avoided whenever possible, and if present, should be presented to the client as a significant drawback that detracts from the annuity's overall investment potential. Option C. The CAS can assume that M&E fees are adequately understood by clients who have expressed interest in annuities, and therefore, a detailed explanation of their mechanics is not always necessary. Option D. The CAS should thoroughly explain the purpose and function of M&E fees, detailing what they cover and their potential impact on the contract's value, and assess if these fees are commensurate with the guaranteed benefits and features provided to the client. The correct answer is A. M&E fees are a standard component of variable annuities and are generally accepted as reasonable if disclosed, requiring no further in-depth justification beyond their presence in the contract. Explanation. The evaluation methodology shows that understanding the nature and impact of mortality and expense, M and E fees is crucial for a certified annuity specialist, CAS, when advising clients. This scenario is professionally challenging because M and E fees, while a legitimate component of many annuity products, can significantly erode a client's returns over time. A CAS must be able to articulate these costs clearly and ensure they are justified by the benefits provided, aligning with the client's best interests and regulatory disclosure requirements. The core challenge lies in balancing the product's features and potential benefits against its inherent costs, ensuring transparency and suitability. The correct approach involves a thorough analysis of the M and E fees in the context of the specific annuity product and the client's financial goals and risk tolerance. This means understanding how these fees are calculated, what they cover, e.g., mortality risk, administrative expenses, guaranteed benefits, and their potential impact on the contract's value over its lifespan. A CAS must be able to explain these fees in plain language, demonstrating how they are reasonable given the guarantees and features offered by the annuity. This aligns with the regulatory framework's emphasis on suitability, disclosure, and acting in the client's best interest, ensuring that the client fully comprehends the cost structure and its implications before purchasing. An incorrect approach would be to overlook or downplay the significance of M and E fees. This could manifest as simply stating the fees exist without explaining their purpose or impact, or assuming that because they are standard, they are automatically acceptable. Such an approach fails to meet the regulatory requirement for clear and comprehensive disclosure. Another incorrect approach would be to focus solely on the potential benefits of the annuity while minimizing the discussion of costs, creating a misleading impression of the product's overall value proposition. This violates the ethical obligation to provide a balanced and accurate representation of the product. Furthermore, failing to assess whether the M and E fees are commensurate with the benefits provided, or if alternative products with lower fees but similar benefits exist, would be a failure in due diligence and a breach of the duty to act in the client's best interest. The professional decision-making process for similar situations should involve a structured evaluation of any product's cost structure. This includes 1. Identifying all fees and charges associated with the product, particularly those that are ongoing or impact long-term performance. 2. Understanding the purpose and justification for each fee. 3. Quantifying, to the extent possible, the impact of these fees on the client's projected outcomes. 4. Clearly and transparently communicating this information to the client, ensuring comprehension. 5. Comparing the product's fee structure and benefits against alternatives to confirm suitability and value. 6. Documenting the entire process and the client's understanding and acceptance. Question 11. Performance analysis shows that a client's annuity, purchased 5 years ago, has experienced moderate growth, but is now facing a potential need for increased income due to unexpected medical expenses. The annuity contract includes a guaranteed minimum withdrawal benefit, GMWB rider, and a guaranteed minimum income benefit, GMIB rider. The client is unsure which rider, if either, would best serve their immediate need for a higher, stable income stream considering the contract's current value and the potential impact on future death benefits. What is the most appropriate course of action for the certified annuity specialist, CAS, in advising this client? Option A. Advise the client to elect the GMIB rider, as it is designed to provide a guaranteed income stream for life, which directly addresses the client's need for increased income. Option B. Thoroughly review the specific terms and conditions of both the GMWB and GMIB riders. Consult with the issuing insurance company for clarification on their application and impact on the client's specific situation, and then present a detailed comparison of the options and their consequences to the client, ensuring suitability. Option C. Recommend that the client surrender the annuity to access the current cash value and seek alternative income-generating investments, as riders can be complex and may not offer sufficient immediate benefit. Option D. Suggest the client activate the GMWB rider and withdraw the maximum allowable amount, as this rider allows for flexible withdrawals that can be increased over time, potentially meeting the income need. The correct answer is A. Advise the client to elect the GMIB rider, as it is designed to provide a guaranteed income stream for life, which directly addresses the client's need for increased income. Explanation. This scenario presents a professional challenge because it requires the certified annuity specialist, CAS, to interpret and apply specific rider provisions in the context of a client's evolving financial situation and stated objectives, while adhering strictly to U.S. federal and state insurance regulations governing annuities and their riders. The CAS must balance the client's immediate need for income with the long-term implications of rider elections, ensuring full disclosure and suitability. The correct approach involves a thorough review of the specific rider language, consultation with the issuing insurance company for clarification on its application, and a detailed discussion with the client about the trade-offs and consequences of each rider option. This approach is professionally sound and ethically mandated because it prioritizes informed client consent and suitability, which are cornerstones of U.S. insurance law. Regulations like the NAIC Suitability and Annuity Transactions Model Regulation and its state-adopted versions require agents to have reasonable grounds for believing a recommendation is suitable for the client's financial situation, needs, and objectives. This includes understanding the features, benefits, and risks of any rider. Direct consultation with the insurer ensures accurate interpretation of the rider, preventing misrepresentation. An incorrect approach would be to assume the rider's standard application without verifying its specific terms or consulting the insurer. This fails to meet the suitability standard, as the CAS may not fully understand the rider's impact on the client's specific circumstances. It could lead to misrepresentation of the rider's benefits or limitations, violating federal and state laws that prohibit deceptive practices and require accurate product information. Another incorrect approach would be to advise the client based solely on the client's initial stated preference, without exploring all available rider options or their implications. This neglects the CAS's fiduciary-like duty to act in the client's best interest by not presenting the most advantageous or appropriate rider for their current situation. It also risks violating suitability regulations by not adequately assessing the client's needs and objectives in relation to the available product features. A third incorrect approach would be to recommend a rider that appears beneficial on the surface, but has hidden costs or limitations not fully explained to the client. This constitutes a failure in disclosure and could be considered a deceptive practice, violating regulations that mandate transparency regarding all material aspects of an annuity product, including rider costs and limitations. The professional decision-making process for similar situations should involve a systematic review of the annuity contract and its riders, direct communication with the issuing insurance company for definitive interpretation, a comprehensive assessment of the client's current financial situation, risk tolerance and objectives, and a clear documented explanation of all options, their benefits, drawbacks, and costs to the client. This ensures compliance with suitability, disclosure, and anti-fraud provisions of U.S. insurance law. Question 12. Implementation of a retirement income strategy for a client who has expressed a strong desire for immediate, guaranteed income from an annuity. What is the most appropriate initial step for a certified annuity specialist to take? Option A. Focus solely on explaining the features and benefits of various annuity payout options, without delving into the client's broader financial context. Option B. Recommend a fixed annuity with a low surrender charge, assuming this provides the best balance of immediate income and flexibility for the client. Option C. Conduct a comprehensive financial needs analysis, including an assessment of the client's overall financial situation, risk tolerance, and long-term retirement goals before presenting specific annuity options. Option D. Immediately present the annuity product that offers the highest guaranteed immediate income payout, as this directly addresses the client's stated primary objective. The correct answer is C. Conduct a comprehensive financial needs analysis, including an assessment of the client's overall financial situation, risk tolerance, and long-term retirement goals before presenting specific annuity options. Explanation. This scenario presents a professional challenge because it requires the certified annuity specialist, CAS, to balance a client's stated desire for immediate income with the long-term implications of annuity product selection and the regulatory duty to act in the client's best interest. The CAS must navigate the complexities of different annuity types, their associated fees, surrender charges, and the client's evolving financial needs and risk tolerance, all within the strict confines of U.S. federal and state insurance regulations governing annuity sales. Careful judgment is required to ensure the recommended product not only meets the client's immediate income needs, but also aligns with their overall retirement objectives and financial capacity, avoiding recommendations that could lead to significant financial detriment for the client. The correct approach involves a thorough needs analysis that goes beyond the client's initial stated preference. This includes a comprehensive review of the client's entire financial picture, including other assets, income sources, expenses, health status, and risk tolerance. The CAS must then present a range of suitable annuity options, clearly explaining the features, benefits, risks, fees, surrender charges, and tax implications of each. The recommendation must be supported by documentation demonstrating how the chosen product aligns with the client's best interests, considering their specific circumstances and objectives. This aligns with the fiduciary duty and suitability requirements under U.S. insurance law, which mandate that recommendations be appropriate for the client, and that all material information be disclosed. An incorrect approach would be to immediately recommend the annuity with the highest immediate payout without further investigation. This fails to consider the client's overall financial situation and long-term needs, potentially leading to a product that is unsuitable or carries excessive surrender charges that would penalize the client if their circumstances change. This violates the duty to act in the client's best interest and the suitability rules. Another incorrect approach would be to recommend a complex, high-commission annuity product that offers a slightly higher immediate payout but carries significant hidden fees or restrictive riders that are not fully explained to the client. This constitutes a breach of disclosure requirements and potentially violates anti-fraud provisions, as it prioritizes the agent's compensation over the client's well-being. A third incorrect approach would be to push the client towards a specific annuity product solely because it is the one the CAS is most familiar with or has the best commission structure, without objectively assessing if it is the most appropriate option for the client's unique retirement goals and risk profile. This demonstrates a conflict of interest and a failure to uphold the professional standard of care. Professionals should employ a structured decision-making process that begins with a deep understanding of the client's needs and objectives, followed by a diligent research and comparison of suitable product options. Transparency and clear communication regarding all aspects of the product, including costs and risks, are paramount. Documentation of the entire process, from needs analysis to product recommendation and client consent, is essential for demonstrating compliance and ethical conduct. Question 13. Which approach would be most appropriate for a certified annuity specialist when explaining the potential future income from a variable annuity with a participation rate feature to a prospective client? Option A. Use a general industry average for participation rates to provide a ballpark estimate of potential income, stating that actual rates can vary. Option B. Explain the participation rate by referencing the highest historical rate achieved by the annuity, emphasizing its potential for strong growth. Option C. Assume the participation rate is a guaranteed component of the annuity's payout and explain it as such to the client. Option D. Consult the annuity's prospectus and any supplemental actuarial information to understand the specific methodology and limitations of the participation rate, and then clearly articulate these details, including any caps or floors, to the client in the context of their financial goals. The correct answer is B. Explain the participation rate by referencing the highest historical rate achieved by the annuity, emphasizing its potential for strong growth. Explanation. This scenario presents a professional challenge because annuity participation rates are a critical component of how future income is projected, directly impacting the client's financial security in retirement. Misinterpreting or misapplying participation rates can lead to significant underestimation or overestimation of potential annuity payouts, creating a fiduciary duty breach and potential client dissatisfaction or financial harm. The Certified Annuity Specialist, CAS, designation implies a commitment to ethical conduct and adherence to regulatory standards governing annuity sales and advice. The correct approach involves a thorough understanding of the specific annuity product's participation rate methodology and its implications for the client's individual circumstances, including their risk tolerance and retirement income needs. This requires consulting the product's prospectus and any relevant actuarial memos, and then clearly explaining to the client how the participation rate functions, including any caps, floors, or limitations, and how it influences the potential payout. This aligns with regulatory requirements for full and fair disclosure and the ethical obligation to act in the client's best interest by ensuring they understand the product's features and potential outcomes. An incorrect approach would be to use a generic or average participation rate without verifying it against the specific product documentation. This fails to meet the duty of care and could lead to inaccurate illustrations, violating regulations that mandate accurate product representations. Another incorrect approach would be to solely rely on marketing materials that might highlight the highest possible participation rates without disclosing the conditions or limitations attached. This constitutes a misrepresentation and a failure to provide complete information, which is a direct violation of ethical standards and consumer protection laws. Finally, an incorrect approach would be to assume the participation rate is fixed and unchanging, ignoring any provisions for adjustments or fluctuations as outlined in the contract, which would also lead to inaccurate projections and a breach of disclosure obligations. Professionals should employ a decision-making process that prioritizes understanding the specific product details, consulting official documentation, and transparently communicating all relevant information to the client. This involves a proactive approach to information gathering and a commitment to client education, ensuring that the client can make an informed decision based on a complete understanding of the annuity's features, including how participation rates affect potential income. Question 14. The analysis reveals that a prospective client, while expressing a strong desire for tax-deferred growth through a deferred annuity, also emphasized the critical importance of having immediate access to a significant portion of the invested funds in case of an unforeseen emergency. The client has indicated that, while they don't anticipate needing the funds soon, the possibility of a sudden need for cash is a primary concern influencing their investment decision. Given this dual objective, which of the following represents the most appropriate implementation strategy for a certified annuity specialist? Option A. Focus solely on the tax-deferred growth benefits of the annuity, highlighting the potential for long-term accumulation and deferring detailed discussion of surrender charges until the application process. Option B. Recommend a deferred annuity with a clear and detailed explanation of the surrender charge schedule, the penalties for early withdrawal, and the potential impact on the death benefit if funds are accessed prematurely, while also exploring riders that might offer limited access without full surrender. Option C. Advise the client that deferred annuities are inherently illiquid and not suitable for individuals who prioritize immediate access to funds, suggesting alternative investment vehicles instead. Option D. Proceed with selling a standard deferred annuity, assuring the client that while there are surrender charges, they are unlikely to be an issue given the client's long-term investment horizon. Correct answer is B. Recommend a deferred annuity with a clear and detailed explanation of the surrender charge schedule, the penalties for early withdrawal, and the potential impact on the death benefit if funds are accessed prematurely, while also exploring riders that might offer limited access without full surrender. Explanation. This scenario presents a professional challenge because the client's stated objective of immediate access to funds for a potential emergency, coupled with their desire for tax-deferred growth, creates a conflict. The challenge lies in balancing the client's immediate liquidity needs with the inherent illiquidity and surrender charges associated with deferred annuities, while adhering to regulatory requirements for suitability and disclosure. Careful judgment is required to ensure the client fully understands the implications of their choices, and that the recommended product aligns with their true financial situation and risk tolerance. The correct approach involves thoroughly explaining the surrender charge schedule, the potential penalties for early withdrawal, and the impact on the death benefit if funds are accessed prematurely. This approach prioritizes clear and comprehensive disclosure, ensuring the client is fully informed about the trade-offs between tax deferral and liquidity. Regulatory justification stems from the principles of suitability, which mandate that recommendations must be in the client's best interest, and the requirement for full and fair disclosure of all material terms and conditions, including fees and charges. Ethically, this approach upholds the fiduciary duty to act in the client's best interest by providing them with the information necessary to make an informed decision. An incorrect approach would be to proceed with the sale of a deferred annuity without adequately addressing the client's stated need for immediate access to funds. This failure to explore the liquidity implications and potential penalties for early withdrawal would violate the suitability rule, as the product may not be appropriate given the client's expressed need for readily available cash. Another incorrect approach would be to downplay or omit information about surrender charges and early withdrawal penalties. This constitutes a failure of full and fair disclosure, misleading the client about the true cost and accessibility of their funds. Ethically, this would be a breach of trust and could lead to significant financial harm for the client if an emergency arises and they are unable to access their funds without substantial loss. Professionals should employ a decision-making framework that begins with a comprehensive understanding of the client's financial situation, objectives, and risk tolerance. This involves active listening and probing questions to uncover any potential conflicts or misunderstandings, such as the one presented here regarding liquidity needs. Once the client's needs are clearly understood, the professional should then assess which products, if any, are suitable. For each suitable product, a detailed explanation of all terms, conditions, fees, charges, and potential risks must be provided. The client should be given ample opportunity to ask questions and should be encouraged to seek independent advice if necessary. The ultimate decision should rest with the client, based on a complete and accurate understanding of the product's features and their implications. Question 15. The performance metrics show a significant upward trend for a variable annuity product that client is interested in. The client is eager to understand how this performance translates to their potential returns. As a certified annuity specialist, CAS, what is the most appropriate next step to ensure full regulatory compliance and ethical client service? Option A. Proceed with a thorough explanation of the performance metrics, assuming the client is familiar with the general concepts of variable annuities and their associated disclosures. Option B. Provide the client with a summary of the performance metrics and then direct them to a website where they can access the annuity's prospectus. Option C. Confirm that the client has received and had an opportunity to review the annuity's prospectus before discussing the performance metrics in detail. Option D. Immediately discuss the performance metrics in detail, highlighting the positive trends, and then offer to send the prospectus for the annuity. The correct answer is D. Immediately discuss the performance metrics in detail, highlighting the positive trends, and then offer to send the prospectus for the annuity. Explanation. This scenario presents a professional challenge because it requires the certified annuity specialist, CAS, to navigate the critical requirement of prospectus delivery in a timely and compliant manner, balancing the client's immediate interest in reviewing performance with the legal obligation to provide essential disclosure documents. The pressure to act quickly based on performance data can create a temptation to bypass or delay procedural steps, which carry significant regulatory and ethical risks. Careful judgment is required to ensure that client understanding and regulatory compliance are prioritized over the expediency of discussing performance. The correct approach involves ensuring the prospectus is delivered to the client before or at the time of the proposal or discussion of the annuity's performance metrics. This aligns with the fundamental principle of investor protection, which mandates that prospective purchasers of securities receive all material information necessary to make an informed investment decision. Specifically, U.S. federal securities laws, primarily the Securities Act of 1933, require that a registration statement be effective and that prospectus, containing detailed information about the security and the issuer, be delivered to investors. For variable annuities, which are securities, this prospectus is paramount. The regulatory intent is to prevent sales based on incomplete or misleading information, ensuring the client has the opportunity to review risks, fees, and investment objectives before committing funds. An incorrect approach would be to discuss the performance metrics in detail and then offer to send the prospectus afterward. This fails to meet the legal requirement of prospectus delivery prior to or at the time of the offer or sale. The client is being exposed to investment performance without the full context of the underlying risks, fees, and investment strategy as detailed in the prospectus, potentially leading to a decision based on incomplete information. This constitutes a regulatory failure under U.S. securities laws and an ethical breach of fiduciary duty, as it prioritizes the sale over informed consent. Another incorrect approach would be to assume the client has already received and reviewed the prospectus from a previous interaction or a different product. While a client might have prior experience, each annuity product has its own unique prospectus. Relying on a past delivery or assumption without confirmation is a violation. The CAS has a responsibility to ensure the current, relevant prospectus for the specific product being discussed has been delivered and acknowledged. This oversight can lead to a client being unaware of specific terms or risks associated with the proposed annuity, creating a significant compliance gap. A third incorrect approach would be to provide a summary of performance metrics without any mention of the prospectus, or to only offer a link to the prospectus online without confirming receipt or understanding. While digital delivery is permissible, it must be done in a manner that ensures the client actually receives and has the opportunity to access and review the document. Simply providing a link without confirmation of receipt or offering to discuss its contents is insufficient. The regulatory framework emphasizes actual delivery and the opportunity for review, not just the availability of information. The professional decision-making process for similar situations should begin with a clear understanding of the regulatory requirements for prospectus delivery. Before engaging in any discussion about investment performance or making a proposal, the CAS must confirm that the relevant prospectus has been delivered to the client and that the client has had a reasonable opportunity to review it. If the prospectus has not yet been delivered, that must be the immediate priority. The CAS should then offer to walk the client through key sections of the prospectus, answering any questions they may have, before proceeding to discuss performance metrics. This proactive approach ensures compliance and upholds the ethical obligation to act in the client's best interest by facilitating informed decision-making. Question 16. The monitoring system demonstrates that a client has expressed interest in annuity payment options, but appears uncertain about the long-term implications of each. The annuity specialist needs to guide the client through the choices of life only, life with period certain, and joint and survivor options. Which of the following actions best reflects a professional and compliant approach to assisting this client? Option A. Present the payment options with a focus on the option that typically yields the highest immediate payout, assuming this is the client's primary concern, and briefly mention that payments will cease upon the annuitant's death. Option B. Offer a simplified overview of each option, emphasizing the monthly income amount, and suggest the client make a decision quickly to secure current interest rates. Option C. Provide a detailed explanation of each payment option, highlighting the potential benefits and drawbacks of each, particularly concerning the duration of payments and the risk of outliving the income stream, and encourage the client to ask questions to ensure full comprehension. Option D. Recommend the joint and survivor option, as it generally offers the most comprehensive coverage, without first confirming if the client has a spouse or partner who would benefit from continued payments. The correct answer is C. Provide a detailed explanation of each payment option, highlighting the potential benefits and drawbacks of each, particularly concerning the duration of payments and the risk of outliving the income stream, and encourage the client to ask questions to ensure full comprehension. Explanation. This scenario is professionally challenging because it requires the annuity specialist to balance the client's immediate financial needs with the long-term implications of their chosen payment option, all while adhering to regulatory disclosure requirements. The specialist must ensure the client fully comprehends the trade-offs inherent in each option, particularly concerning the duration of payments and the potential for the annuitant to outlive their income. The core of the challenge lies in providing clear, unbiased information that empowers the client to make an informed decision aligned with their personal circumstances and risk tolerance, without steering them towards a particular option for the specialist's benefit. The correct approach involves thoroughly explaining the nuances of each payment option, emphasizing the trade-offs between payment amount, duration, and the risk of outliving the income stream. This includes clearly defining what life only, life with period certain, and joint and survivor entail, and how each impacts the payout. For instance, a life-only option typically offers the highest periodic payment but ceases upon the annuitant's death, leaving no residual benefit. A life with period certain guarantees payments for a specified period, even if the annuitant dies sooner, but at a reduced periodic amount. A joint and survivor option provides payments for the lifetime of two individuals, usually with a reduced payout upon the death of the first annuitant, offering continued income for a surviving spouse. This comprehensive explanation, tailored to the client's stated goals and concerns, ensures compliance with regulations mandating full and fair disclosure, and upholds ethical obligations to act in the client's best interest. An incorrect approach would be to present the options without adequately explaining the implications of the annuitant outliving their income. Example, simply stating that life only provides the highest payment without detailing the consequence of payment ceasing upon death is a failure of disclosure. This omission can lead to a client making a decision based on incomplete information, potentially leaving them financially vulnerable in their later years. Another incorrect approach is to recommend an option based on a superficial understanding of the client's needs, such as pushing a joint and survivor option without confirming the client has a spouse or partner who would benefit, or without discussing the reduced payout. This demonstrates a lack of due diligence and a failure to act in the client's best interest. Furthermore, any approach that prioritizes the specialist's commission over the client's suitability for a particular option is a clear ethical and regulatory violation. Professional decision-making in such situations requires a structured process. First, the specialist must conduct a thorough needs analysis, understanding the client's financial situation, health, life expectancy expectations, and dependents. Second, they must present all available, suitable payment options clearly and comprehensively, using plain language and avoiding jargon. Third, they must facilitate a discussion where the client can ask questions and express concerns, allowing the specialist to address any misunderstandings. Finally, the specialist must document the client's decision-making process and the rationale behind their chosen option, ensuring transparency and accountability. Question 17. Operational review demonstrates that during initial client consultations for annuity products, representatives are providing a brief verbal overview of the product's primary benefits and a general statement that detailed policy documents are available upon request. What is the most compliant and ethically sound approach to disclosure requirements under the Certified Annuity Specialist (CAS) regulatory framework? Option A. Present a lengthy, highly technical disclosure document at the very beginning of the sales conversation, without any introductory summary. Option B. Rely solely on verbal explanations during initial consultations, emphasizing that detailed policy documents can be provided if the client specifically asks for them. Option C. Offer to provide the full disclosure document only after the client has expressed significant interest or indicated a willingness to proceed with the purchase. Option D. Provide a concise written summary of key features, benefits, and risks at the initial point of sale, along with a clear statement that comprehensive policy documents are available for review prior to contract signing. The correct answer is D. Provide a concise written summary of key features, benefits, and risks at the initial point of sale, along with a clear statement that comprehensive policy documents are available for review prior to contract signing. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of disclosure requirements under the Certified Annuity Specialist (CAS) regulatory framework, specifically concerning the timing and content of information provided to prospective annuity purchasers. The core difficulty lies in balancing the need for comprehensive disclosure with the practicalities of initial sales interactions, ensuring that critical information is not obscured or misrepresented. Careful judgment is required to determine what constitutes adequate disclosure at different stages of the sales process. The correct approach involves providing a clear, concise, and easily understandable summary of key annuity features, benefits, and risks at the initial point of sale, with a commitment to providing more detailed documentation upon request or prior to contract signing. This aligns with the CAS regulatory framework's emphasis on consumer protection and informed decision-making. Specifically, regulations mandate that prospective purchasers receive sufficient information to understand the product's nature, costs, and potential outcomes. This approach ensures that the consumer is not overwhelmed with complex details upfront, but is still empowered to make an informed choice by having access to further information. An incorrect approach would be to solely rely on verbal explanations without offering any written summary or readily available detailed documentation. This fails to meet the regulatory requirement for clear and accessible disclosure, as verbal information can be easily misunderstood, forgotten, or misrepresented. Ethically, it places the consumer at a disadvantage by not providing a tangible record of the product's features and risks. Another incorrect approach is to provide a lengthy, highly technical disclosure document at the very beginning of the sales conversation, without any introductory summary. While technically compliant in terms of providing information, this approach can overwhelm the prospective buyer, making it difficult to grasp the essential aspects of the annuity. This can lead to a lack of genuine understanding, even if the document is technically accurate and complete. The regulatory intent is for disclosures to be understandable, not merely present. A third incorrect approach is to only provide a disclosure document after the consumer has expressed strong interest or made a preliminary commitment. This delays critical risk and cost information, potentially leading the consumer to commit to a product without fully understanding its implications. This practice undermines the principle of informed consent and violates the spirit, if not the letter, of regulations designed to protect consumers from making decisions based on incomplete or delayed information. The professional decision-making process for similar situations should begin with a thorough understanding of the CAS regulatory framework's disclosure mandates. Professionals must prioritize transparency and consumer comprehension. This involves identifying the critical information consumers need at each stage of the sales process and determining the most effective and compliant methods for delivering that information. A tiered approach, starting with a clear summary and offering detailed documentation, is often the most effective way to ensure both compliance and genuine consumer understanding. Question 18. The performance metrics show a consistent decline in the client's overall portfolio value over the past 2 years. Yet the client has expressed a strong desire to ensure their beneficiaries receive at least the total amount they have contributed to the annuity, regardless of market performance. The client is not seeking aggressive growth, but rather a guarantee of principal preservation and a modest death benefit. Which of the following actions best demonstrates adherence to regulatory requirements and professional ethics for a certified annuity specialist? Option A. Suggest a rider that provides a death benefit equal to the highest contract anniversary value, as this is a common death benefit feature. Option B. Proceed with the annuity without any additional riders, as the client's primary concern is principal preservation, which is inherent in many annuity products. Option C. Recommend an annuity rider that guarantees the death benefit will be at least the total premiums paid, and clearly explain to the client how this rider functions, its associated costs, and any limitations, such as how withdrawals might affect the guaranteed amount. Option D. Add a death benefit rider that offers a potentially higher death benefit based on market performance, assuming this will satisfy the client's desire for enhanced protection. The correct answer is C. Recommend an annuity rider that guarantees the death benefit will be at least the total premiums paid, and clearly explain to the client how this rider functions, its associated costs, and any limitations, such as how withdrawals might affect the guaranteed amount. Explanation. This scenario presents a professional challenge because it requires the certified annuity specialist, CAS, to balance the client's stated desire for enhanced death benefit protection with the potential for unintended consequences and regulatory compliance. The CAS must not only understand the mechanics of riders, but also their implications within the broader context of the annuity contract and the client's overall financial situation, all while adhering to strict disclosure and suitability standards. Careful judgment is required to ensure the recommended rider genuinely serves the client's best interests and is fully understood. The correct approach involves thoroughly explaining the specific death benefit rider, including its costs, limitations, and how it interacts with the annuity's accumulation and payout phases. This includes detailing any potential reduction in the death benefit due to withdrawals or surrender charges, and clarifying the exact death benefit calculation method. This approach is correct because it aligns with the CAS's ethical duty of care and the regulatory requirement for full and fair disclosure. By providing comprehensive information, the CAS empowers the client to make an informed decision, fulfilling the suitability standard which mandates that recommendations are appropriate for the client's objectives, risk tolerance, and financial circumstances. An incorrect approach would be to simply add the rider, without a detailed explanation of its features and implications. This fails to meet the ethical standard of informed consent and violates the regulatory requirement for clear and understandable communication of policy terms and costs. Another incorrect approach would be to recommend a rider that offers a death benefit enhancement but significantly increases the contract's fees without clearly articulating this trade-off to the client. This could be considered misleading and a breach of the duty of loyalty, as it prioritizes the sale of a product with higher commissions over the client's net benefit. Finally, recommending a rider that is overly complex or does not align with the client's stated need for simplicity and predictable outcomes would also be an ethical and regulatory failure, as it demonstrates a lack of understanding of the client's preferences and a failure to recommend the most suitable option. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client's stated objectives and underlying needs. 2. Identify relevant annuity features and riders that could address these needs. 3. Conduct a thorough analysis of each potential rider, including costs, benefits, limitations, and impact on the core annuity. 4. Develop clear, concise, and accurate explanations of these riders for the client, using plain language. 5. Assess the suitability of the recommended rider in the context of the client's overall financial picture and risk tolerance. 6. Document the client's understanding and decision-making process. Question 19. Consider a scenario where a client expresses a desire to diversify their annuity holdings beyond traditional fixed or variable subaccounts, specifically mentioning an interest in alternative investments. As a certified annuity specialist, CAS, what is the most appropriate process to address this client's request while adhering to regulatory requirements and ethical obligations? Option A. Recommend alternative investments that are known for their high potential returns. Assuming the client's desire for diversification implies a willingness to accept higher levels of risk and illiquidity without extensive client consultation on these specific factors. Option B. Suggest that the client explore alternative investments outside of the annuity structure, as annuities are primarily designed for traditional investment options and are not suitable vehicles for alternative investments. Option C. Immediately provide the client with a list of various alternative investment funds, highlighting their potential for higher returns, and allow the client to choose which ones they would like to explore further for inclusion in their annuity. Option D. Conduct a comprehensive suitability assessment to understand the client's financial situation, risk tolerance, and objectives. Then research and present alternative investment options that are permissible within the annuity structure, clearly disclosing all associated risks, liquidity considerations, and regulatory disclosures. The correct answer is D. Conduct a comprehensive suitability assessment to understand the client's financial situation, risk tolerance, and objectives, then research and present alternative investment options that are permissible within the annuity structure, clearly disclosing all associated risks, liquidity considerations, and regulatory disclosures. Explanation. This scenario is professionally challenging because it requires the certified annuity specialist, CAS, to balance the client's stated desire for diversification with the inherent risks and regulatory considerations of alternative investments, particularly within the context of annuity products. The CAS must ensure that any recommendations are suitable, compliant with regulation, and align with the client's overall financial objectives and risk tolerance, avoiding the temptation to present complex or illiquid products simply for the sake of offering alternatives. The correct approach involves a thorough suitability assessment that prioritizes understanding the client's financial situation, risk tolerance, and investment objectives before even considering alternative investments. This includes educating the client on the nature, risks, and liquidity of any proposed alternative, ensuring they understand how it fits within their overall portfolio and the specific regulatory disclosures required for such products. The CAS must then demonstrate how the chosen alternative investment option, when integrated into an annuity, genuinely enhances diversification and aligns with the client's stated goals without introducing undue risk or compromising liquidity beyond the client's capacity. This aligns with the fiduciary duty to act in the client's best interest and the regulatory requirement for suitability in product recommendations. An incorrect approach would be to immediately present a range of alternative investment options without a comprehensive suitability review. This fails to establish a foundation of understanding the client's needs and could lead to recommending products that are inappropriate, overly complex, or illiquid for the client's circumstances. Such an action violates the principle of suitability and could expose the client to significant financial harm. Another incorrect approach is to focus solely on the potential for higher returns offered by alternative investments without adequately disclosing and explaining the associated risks, including illiquidity, lack of regulation, and potential for significant loss. This misrepresents the investment opportunity and fails to meet the disclosure requirements mandated by regulations, potentially misleading the client. A further incorrect approach would be to recommend alternative investments that are not permitted within the specific annuity product being considered, or that are not registered or approved for sale in the relevant jurisdiction. This directly contravenes regulatory frameworks governing annuity sales and product offerings, leading to non-compliance and potential legal ramifications. A professional decision-making process for similar situations should begin with a robust client discovery phase to understand their financial profile, goals, and risk appetite. This should be followed by a thorough analysis of how any proposed investment, including alternatives, fits within the client's overall financial plan and the specific annuity product's capabilities. Transparency and clear communication regarding risks, benefits, liquidity, and costs are paramount. Finally, all recommendations must be documented and demonstrably compliant with all applicable regulations and ethical standards. Question 20. The efficiency study reveals that a client is seeking an annuity that provides the highest possible immediate income stream to supplement their retirement income. As a certified annuity specialist, CAS, operating under U.S. regulations, which approach best aligns with regulatory requirements and ethical best practices for addressing this client's request. Option A. Immediately present a variable annuity with a high-income rider, focusing on the potential for income growth, without fully detailing the associated fees and risks of market fluctuations impacting the principal. Option B. Prioritize annuity products that offer the highest commission to the CAS, as this indicates a product that is likely to be well received by the market and therefore beneficial to the client. Option C. Recommend an annuity product that offers the highest guaranteed immediate income payout, ensuring the client understands this payout is fixed and may not adjust for inflation, and that other features like death benefits or growth potential might be reduced. Option D. Suggest a deferred annuity with a long accumulation period, explaining that while immediate income is not available, the potential for significantly higher income in the future justifies the delay. The correct answer is C. Recommend an annuity product that offers the highest guaranteed immediate income payout, ensuring the client understands this payout is fixed and may not adjust for inflation, and that other features like death benefits or growth potential might be reduced. Explanation. This scenario is professionally challenging because it requires the certified annuity specialist, CAS, to balance the client's stated desire for immediate income with the potential long-term implications of annuity features, all while adhering strictly to U.S. federal and state insurance regulations and ethical standards. The CAS must ensure that the client fully understands the trade-offs involved in different annuity features, and that the chosen product genuinely aligns with their financial goals and risk tolerance, not just their immediate expressed need. The correct approach involves a thorough needs analysis that goes beyond the client's initial request for immediate income. This includes understanding the client's overall financial situation, retirement objectives, time horizon, and risk tolerance. The CAS must then present a range of suitable annuity options, clearly explaining the features, benefits, and limitations of each, particularly focusing on how different riders or payout options impact the immediate income stream versus long-term growth or death benefit protection. This aligns with the regulatory requirement to act in the client's best interest, ensuring suitability and full disclosure of material information. Ethical practice dictates that the CAS should not pressure the client into a product that may not be optimal for their long-term financial well-being, even if it superficially meets an immediate request. An incorrect approach would be to immediately recommend an annuity with the highest immediate payout, without exploring other options or understanding the client's broader financial picture. This fails to meet the best interest standard by potentially overlooking more suitable products or features that could provide a more balanced outcome. It also risks violating disclosure requirements if the trade-offs of the high payout option, e.g., lower death benefit, less growth potential, are not fully explained. Another incorrect approach would be to recommend an annuity solely based on commission potential, prioritizing the sale of a product that offers the highest commission over one that best serves the client's needs. This is a clear ethical violation and likely a regulatory breach, as it prioritizes the agent's interest over the client's. A third incorrect approach would be to present only one annuity product that offers immediate income, without offering alternatives, or explaining the nuances of different payout options within that product, or across different annuity types. This limits the client's informed decision-making and may not be the most comprehensive or beneficial solution. Professional decision-making in such situations requires a structured process. First, conduct a comprehensive client needs assessment. Second, identify suitable annuity products and features that address those needs. Third, Clearly and comprehensively explain all relevant features, benefits, risks, and costs, including trade-offs. Fourth, ensure the client understands the information and has the opportunity to ask questions. And finally, document the entire process and the client's informed decision.